live.
We are live. Cool. So Jay-Z and Beyonce just took out a $50 million mortgage, a second one, by the way, on their house in Bel Air. Now, that is a not dumb move. It's a smart move. So meanwhile, Americans are racing to pay off a $300,000 mortgage. One builds wealth, one just creates debt. So what's cracking, everybody? Money Smart Guy Matt Sapaula here, hailing to you from, was it Plano, Texas, Frisco, Texas here? And we're doing something new, something live here. And we're going to introduce here a concept that the idea of being debt-free equals financial freedom. Debt-free equals financial freedom. But the wealthy don't rush to pay off their homes. We're going to explain why here in a second. And more importantly, why they use mortgages and debt on real estate or debt on other assets is a smart financial tool. Also, I'm going to break down exactly why the rich borrow on purpose. We got some notes here for you guys, and I'm going to show you two strategies from an upcoming book here being released August 4th in the next few days called Keep the Keys. And that could change the way you think about your home, mortgages, and debt forever. So joining me in this live stream is my good friend Eloy Benavides, is a stud in the mortgage profession. Eloy, welcome to the conversation, big dog.
Hey, bro.
My man.
Appreciate
All right. Eloy, real quick, tell everybody how long you've been in the mortgage business.
Going on 30 years, so a minute.
You're an OG.
Oh yeah, no doubt, no doubt.
So what the youngsters will call you an unk.
Oh, no doubt, I'm on. Might be unk.
So you bring 30 years of good economies, bad economies.
I've seen the cycles.
Cycles of the dot-com bubble, the Great Recession.
The booms, the busts, yeah. Short ones, long ones.
Right now, Dallas is coming across a big boom, aren't we?
We're booming, yeah. Texas is friendly for corporate entities and business and structures, so it's got good tax implications, right? So a lot of business coming here, creating a lot of jobs. So Dallas and Texas in general is doing really well.
Very good. So we got some notes here for you guys we're going to share, but we also want to share with you what happens though when everything is going right, but also what happens when things go wrong. What happens if somebody gets sick, heart attack, stroke, cancer, you're a homeowner, you're a real estate investor. What happens if you can't make the mortgage payments anymore? So we're not just talking theory. We actually have a case study we're going to discuss here in a second of why many real estate professionals, loan officers, realtors, tax professionals aren't talking about protection during the worst times in one's life. So let's break this down here. This article, let me get this article here of Jay-Z and Beyonce. So let me just summarize this article here. If you guys didn't hear, that's why you're on this YouTube channel. But Jay-Z and Beyonce just took out a $57.75 million mortgage on the Bel Air mansion in Los Angeles. But they're billionaires though.
Yeah, no doubt. Why do they have cash, right?
They have cash. So why are they borrowing $50 billion? So when you're looking at the situation of why they're doing it, and this is the second one. So according to the article, here's a breakdown, okay? This is the second mortgage. They've got $50 million mortgage. Now, Eloy, what's the current interest rate environment today?
Today, just for a traditional home buyer, you're looking at high sixes, low sevens on an FHA conventional deal.
So they got a loan at 5%. Now they got a $50 million loan based on their Morgan Stanley private banking. Now I know what that means, but you as a debt guy, mortgage guy, what does that really mean? Was this a traditional mortgage they would get through a traditional mortgage company?
So most mortgages are backed by a government insurance of some sort, a Fannie, a Freddie, FHA. The government's involved and they're lending you borrow. They're insuring the money to the bank in case you default, right? So everything is based on government funding, which is based on the federal fund rate, which is what controls a little bit of the rate. So that's how it's, but this private banking is literally a bank without any government intervention saying, hey, I'm gonna let you borrow money based on your criteria, which it seems in this case is their assets.
That's right. So they're borrowing not against necessarily the property, they're borrowing against the asset of not the property, but the investments they might have inside their account.
Theoretically, is it even a mortgage because they're doing against their capital they have in the bank? Yeah.
It's funny that you mentioned that because they first bought the house with a $52.8 million mortgage from Morgan Stanley.
Yeah.
Right, at 3.5 or 3.15%. So they initially bought it in 2017 for 3.15%, and they're refinancing or getting a loan against it. It may not be against their property, but against their real estate assets overall at 5%. So why is this? Is this a sign of financial trouble? I don't know. What do you think?
You know, you would think you need to borrow money, you're hurting, you don't have the cash. But in reality, they're leveraging their assets to get a better deal. And it's not just the capital money you have in the bank, but not just leveraging, but now you have deductions and write-offs and tax benefits that weren't there had you bought it cash. So they're not just taking their money that they have to pay off a debt and not have debt, which in normal terms seems good, not having a bill, but they've actually converted it to an asset where it's creating interest gains to their own funds while they're not having a debt at the same point in time. Actually, they're paying interest themselves.
That's right.
Right.
So they got the initial mortgage to Morgan Stanley at $52.8 million. Just after 78 years later, they get a $50 million loan at 5% through Morgan Stanley Private Banking. So I realized that when I was coming up, when I started my account, I've got an account and with a brokerage. And hey Matt, you got a significant amount of money in your stocks, bonds, and mutual funds. Would you like a loan? I said, for what? To like margin. I was thinking margin to buy more stocks, right? No, for anything that you need. So what are you talking about? Yeah, we can get you a loan with our private banking division, a loan, a personal loan, whatever the case may be. It's right.
Yeah, I get it.
And the collateral is the money I have in my stocks, bonds, and mutual funds,
100%.
ETFs, etc. So that's why a lot of people don't realize that once you get an account with one of these companies, for example, I know Patrick. He and by the way, I'm not saying anything that's private.
Sure.
This is something that's public information, just to refresh everybody, just in case you didn't know. I was there when Patrick bought the most expensive home, the Bayshore Colony there in Fort Lauderdale.
Okay.
And Patrick didn't take a traditional mortgage.
Yeah.
He had a lot of significant money inside his brokerage accounts, and he took a loan against his brokerage account to buy the house at 20-some million.
Yeah.
Now the house is 30-some million.
I mean, honestly, most jumbo loans anyway cut off at like $1 million or $2 million. That's where you start, and it's harder to get those big money. So he avoided headache, he avoided fees, all the processing and transactions. He just got it a lot faster, cheaper, and he's paying himself.
So it's a good point. Let's say I want to buy a $3 million home, a $5 million home. How would I do it?
It's tough. There really is. That's more independent banking. So you have to go one-on-one to every bank and ask what their criteria is, what the conditions are, and it's not consistent. So as a consumer, you have to maybe shop 10 different banks. You have to get exceptions left and right, and it's not a 2-week process. It's a little more complicated. But doing this, you're essentially buying it cash. Yeah. Right. So you avoided that. Plus, you avoid all the costs.
Yeah.
Talking about 3 to 4% of $3 million. That's a lot of money you're paying in closing costs that you're avoiding. So you're avoiding the fees, plus you're paying yourself.
So obviously they're not under financial trouble.
None at all.
Okay, they're not doing it because they're hurting. So just to kind of break things down, their initial mortgage is $226,901 a month.
Yeah.
But combined now they have a $637,000.
Yeah.
$630,000 mortgage.
Against how much of a value? Right?
I think it's right now worth $100 million.
Yeah. That's
right.
pennies.
It's pennies, right?
Yeah.
And so I put down here leverage. What do you think? So what do you think that you're going to use that $50 million for? They took out $50 million from their borrowed against it. What are some of the things that wealthy people do by loaning against their home?
I mean, you would think they pay off debt, but they're going to go invest in something else. They're going to leverage that money, and they're going to multiply it times over. So as opposed to having one house free and clear, they're borrowing money against it to go buy other houses leveraged with better rates that they're paying themselves back at. So it's just about leverage, right? Multiplying my investment. As opposed to getting on 1, I'm getting on 5 the same rate. So I just did that.
So this is game, everybody. This is why you're part of the 7-Figure Squad YouTube channel, because wealthy people, millionaires, use debt to leverage, not live a lifestyle on.
100%.
And so equity in a home, everybody, is not cash. Equity was not cash, and if you can't access it when life hits, cash in the house is useless. So let's talk about this. The second thing here I want to talk about is because a lot of people think that I got to pay off my house early, be debt free, own the home, and so I was sharing with you a scenario where a lot of people say, okay, traditionally speaking, Eloy, when somebody says, I'm talking to my loan officer, I'm talking to my realtor, what's your traditional advice that most people get when say, I want to send another $1,000 extra to my house and pay it off?
Most consumers ask me, it's a really weird question, they ask me, well, what am I going to pay on this loan for 30 years? What's my total amount paid of interest? And I'm like, well, that's a really loaded question. We don't really have the aspect to see figures 30 years out. We haven't seen the growth of money, appreciation. We don't quite understand exponential growth to that level.
Yeah.
So for me to give you a number of $10 million today for 30 years from now, it doesn't quite equate. But I mean, so they ask, how can I pay it off faster? Because they don't want to pay $10 million for a mortgage. So their mind is, I'm paying $10 million on 30 years. Well, what about 15? So they asked me, I said, all right, well then add $1,000. which sounds great because I'm cutting the interest down from 10 million to 5 million, let's just say. But what they haven't been doing is they haven't been taking that $1,000 and putting it to work for them. They're thinking debt, eliminate debt, they're not thinking growth, because exponential growth, I mean, that's where it's at, right? It's underestimated by far.
Yep.
And debt, I think, is a little too heavy. It's too real. We feel it today, but we don't feel the growth today because it's 30 years from now, so we can't quite conceptualize what that looks like.
For sure. Years. So I wrote down this little, axis chart. So this signifies a 30-year mortgage balance.
Yeah.
So in the first 5, 7, 10 years of a mortgage, how much is it really cutting into the balance of the loan?
Nothing. You don't hit on a 30-year. You don't hit half of your payment going to principal until about year 19.
Woo!
So it's year 19 when half your payment or more starts being applied towards your principal balance. So honestly,
19.
The first 19 years, less than half your principal and interest payment is going to your mortgage balance.
So you're paying interest.
More than half.
Wow. Okay. And so I say on the back end, though, where mortgage laws or tax laws allow us to write up to $750,000 of mortgage interest on a house.
Yeah.
So that's good that we can deduct it, but
100%.
we got to pay it to deduct it.
100%.
Okay. So the thing also here I'm gonna cover and make sure is when you send additional mortgage prepayments to the bank, the mortgage company, you're thinking proportionally you're safer because I'm paying this house off faster. But what happens if you run into a disaster? And we just talked about people in Hawaii right now. They had a tsunami in Hawaii.
Yeah.
We had wildfires in California. We got hurricanes on the East Coast, Hurricane Harvey. My friends in Houston, Rodolfo and Ceci Vargas in Houston, they're flooding in downtown Houston to the bottom of certain turnpikes there. Earthquakes, natural disasters can happen. And if you're sending that extra money to the mortgage company, you're thinking that you're more safer. Actually, who's really safer is the mortgage company. It's the mortgage company, right? Not you. Because here's why. So let's say, Eloy, I have private mortgage insurance. Okay? I have PMI.
Protected, right?
Because something happens to me. My banker said I have private mortgage insurance. I pay another $100 extra a month for it. What break down the reality of what PMI really is for?
Private mortgage insurance was created to offset some of the risk when consumers weren't putting 20% or less down. Pre PMI, you had to put 20% down in order to buy a house. So if you didn't have 20% down to buy a home, you couldn't buy a home. It wasn't there. It wasn't an option. You had to have 20%. Then they invented the vehicle called PMI, private mortgage insurance, where basically the banks are asking the consumer to taking on additional risk as a bank. I'm going to ask you to pay another insurance policy for my protection, the bank. So in case you do default and are less than 20%, I can recover at 20% also. So there is really very little to no protection for you, the consumer, with private mortgage insurance. That's really made for the bank's benefit, not for the consumer's benefit.
So if my house burns down, or my house gets destroyed in an earthquake, or my house gets destroyed in a hurricane, right? And let's say I bought a house at $500,000 and accumulated now to seven figures squad. It gained in value to 7 figures, so $1 million house. But I bought it for $500,000. Mm-hmm. Let's say just that number there. Let's say I have $500,000 of equity. Okay, homeowners insurance kicks in, right? PMI kicks in. So if in that disaster, PMI is really only if you don't pay the mortgage, right?
Yeah. Let's say you didn't have insurance at all and the house burned down and you're self-insured, let's just say in that case.
Okay.
Then you lose everything, and the mortgage company didn't lose a penny because they have every single insurance covered, but you lost it all.
Yeah.
So, but the mortgage didn't see any of that, so that's even worse. But back to your point, if you are insured, the insurance, the homeowner's insurance covers the reconstruction cost.
Yeah.
But then again, the mortgage insurance company is 100% protected towards any losses, so they're still fine and gravy.
So the most protected person right now in this entity is between the homeowner and the bank is the bank. Okay, so you want to be the bank. You want to be the most protected. You want to have the things the most advantageous for you. So if the cost of rebuilding the home, let's say the insurance company says it costs $500,000 to rebuild the house, but you still got a $500,000 mortgage.
Yeah.
Right?
It's all on you.
It's all on you.
Yeah.
And what happens if, in the meantime, that $500,000 of equity is destroyed?
Yeah, I mean, the PMI is not going to kick in and give you any benefit. Your other insurance protections can be given, so it's all on you. And should you default, the bank still doesn't incur any loss because they have the PMI against it to protect you from any loss. So really, the one at risk here is you,
Yeah.
and the bank has. So back to your point, how do we benefit there? We have to become the bank.
Yeah.
Which is what we're discussing here.
Yep, I love it. So in this scenario, that balance is eventually 19 years going to be starting to be paid on 30 years. But the question is, what do I do with this extra $1,000? So Matt, if you're saying don't send it to the mortgage company, don't send it to the bank, who do I send it to? Well, let me give you a white paper. Okay, let me give you a white paper I've used since 2009 when I saw this during the Great Recession. It's called The Trade-Off Between Mortgage Prepayments and Tax Deferred Savings, written by an economist at the Federal Reserve Bank of Chicago named Gene and Raman.
Yeah.
When I was first starting radio, I interviewed him on a radio show. I didn't know what I was doing, but I had him on the phone. But anyway, he says here, a lot of people make a mistake. A lot of people make the mistake of mortgage prepayments and tax-deferred retirement savings. Anyway, basically, the bottom line is Americans can save themselves over $1.5 billion by redirecting, instead of going to a mortgage company, by putting inside their own tax-advantaged retirement accounts, like a Roth IRA, like an index universal life insurance policy, permanent life insurance policy. Here's an example. If you do that, you're now in control. You are in control now with $1,000 a month, in addition to the rate of return you're earning on your net savings growth or interest that you're earning. So now the idea, though, is let's say your mortgage is starting to be paid up 19th year. Yeah. The idea is that cash value inside your policy, the cash value inside whatever, let's say a brokerage account, that non-tax advantage retirement account, or non-tax advantage brokerage account, you put it there and just growing, it's earning about 5 to 7% rate of return. The idea is that in the 15th year, before the 19th year, you just have as much cash in that policy or cash in that brokerage account as you do loaning or the mortgage on the property. And all you got to do then is take money from one pocket, your cash, to pay out the debt in the other pocket, mortgage.
100%.
And you gave me a concept here. I wrote it down. The difference between self-insuring, which is what a lot of people do, but now you're self-mortgaging.
Yeah, 100% self-mortgaging, right? They're taking what they should have been paying down prior to their own asset, as opposed to having this debt not exist. They're having the asset to offset the debt that was there, right? So now they're self-mortgaging. But this is just important because there's two things that people are underestimating. They're underestimating their ability to discipline themselves, and then number two, they're underestimating the power of exponential growth. And those are two things to really difficult to control. But the insurance vehicle kind of makes you be disciplined in that payment, as the mortgage payment does, right? But the mortgage payment's more traditional. That's what we're taught as kids: go buy a house, get a mortgage. We're not taught go get an insurance policy to become wealthy to self-mortgage. That's a concept that we really haven't been learning. But yes, by all means, discipline. I think we think we're going to make the payment or think we're going to set assets, and we really don't. And then number two is exponential growth. I mean, the rule 72 comes into play. You know, every 10, 9, 7 years, whatever it is, it starts doubling. So you get to this point and it just skyrockets.
Right.
And here we hit this, it doesn't skyrocket, it goes to zero. So it's a zero-sum game here. This is just infinite growth. So we're not taking advantage of that infinite growth to our benefit.
So here, right, let's say you have just as much cash in your insurance policy or cash in your investments as you do mortgage balance. You got options. One, you can pay off the house.
Absolutely.
Right? Not advisable, but we're back down to why Jay-Z and Beyonce are taking a $50 million house on her Bel Air home. The second one is they can go back to you and say, hey man, I want to invest in some more commercial or real estate. I want to invest in some more property.
100%. Leverage.
Right? Yeah. They can leverage. Or number three, they can just keep harvesting that cash to earn them a higher rate of return. And maybe that interest starts paying this mortgage balance by itself instead of them going to work for another job.
100%.
Right? So bottom line, you've got options, you got control, you got liquidity, you got flexibility, and you stay protected and positioned for growth. And so many wealthy people keep mortgages on purpose to maximize tax strategy and maintain their financial flexibility, which puts me to my third and fourth one here. What happens when we get sick, Eloy? What happens when we get sick? There's a change in health, and yet many people are setting their money. And the counterpoint to this is Dave Ramsey. Dave Ramsey is what? Be debt free, be debt, pay off that house, let's have a mortgage burning party.
I mean, that's great for, investor homeowner 101. It's great concept for if you're in debt trouble and don't know how to get out, you're stuck with credit card debt. It makes sense. That's step number one. But that's when you're young, and as you get older and you need investments and you're trying to mature and become independent, it's not the right strategy. Hoarding cash sounds decent in most cultures. Hey, we don't trust banks. We're going to hide it. We're going to have it ourselves. But the dollar is devaluing, right? Literally it buys less today than it did yesterday. 5 years ago, I mean, you can't buy what you get, a gallon of milk.
That's the silent tax. It's called inflation.
So there's that. There's that situation. But then you actually have the tax advantages. What if you put that money to play for yourself and you get tax consequences that are beneficial to you or leveraging? So there's so many things you can do with cash besides hanging on to cash, which is what we're doing with the mortgage. We're hanging on to that cash. We're paying off the asset and it's stuck. When do we access it? How? Equity loans, that's great. But when you're in trouble, typically the economy's in trouble. So banks get tighter regulations, tighter guidelines, higher rates, and it gets tougher to get those. Not just that, what kind of costs am I paying to obtain those funds? Closing costs? It's like buying another house. I mean, it's 2 to 3% of the funds you're trying to access. So you're talking about $10,000 at a time that you're probably in time for crunch and fast. And these are not fast processes. It takes a month.
Someone has a change in health. Yeah. They're not working. They have they're going through some serious health change. Like for example, we just did a video on Deion Sanders having cancer. Okay. Yeah. Thank God he's in a financial position he's in. He can still pay the mortgage. No problem. But what is the common person trying to come up, change their bag, going from 100,000 income to 7-figure income, and then miss mortgage payments, and they can't pay the house. The whole Dave Ramsey philosophy of all the equity inside your house because you've been rushing to pay it off.
Yeah. So what happens there is most people live paycheck to paycheck. It's like 80% of Americans, something like that. So you get sick, you miss a paycheck or two, fall behind on the mortgage. Next thing you know, you're 3, 4, 6 months behind on mortgage. You're forced to fire sell the property, not at full value. Let's say 80%.
Fire sell the property. Explain what fire sell means for people.
There are people that will want to buy your property at a lower price today, cash. They're not going to offer you full value. They're not going to offer you 100% what it's worth, maybe not even 95%. They'll offer you 65 to 70, 75% of the property. So you're taking a big haircut to access cash today. Yep. Are you still profitable? Probably, but you're not maximizing your return. And then just to pay off your debts, there's no collateral, there's no insurance. You're back to square one, zero-sum game. We have cash on hand and no leverage, no investments. Yep.
And at home was supposed to help you build wealth. Except then at that point, it's now starting to create more debt for you.
It did, but at some point it came at a cost, significant one when you need it the most. So access to capital can be tricky in those situations.
So when you're looking at an insurance side of things, this is why we talk about living benefits with inside life insurance policies. Life insurance policies today, you don't have to die to use. True. You know, for example, if somebody has a heart attack, stroke, cancer, they get a check issued to them right away. By the way, we have another Keep the Keys series coming up. We had a client who got a policy for $70, $80 a month. Then 6 months later, she finds out she has lymphoma, right? And then she's got to go from this side of Florida to the other side of Florida to get the chemotherapy treatment that she really wanted. And the coolest part of that, she got a $1 billion policy for $70 a month. Nice. And the insurance company gave her a $500,000 check.
Wow.
And so she was able to deal with her chemotherapy. She was able to keep the keys to the house. Yeah. She was able to figure out how, mentally speaking, that she's not rushed to go back to where she's got 3, 4 kids, a husband, but she's alive and well today.
There's 2 things there you mentioned, right? We said keep the keys. As a loan officer, my focus is really getting you into the house.
Yeah, get the keys.
Get the keys, right? And I qualified you. You had a good job. That was covered. But what's going to happen in 20, 30 years? When you buy a house, you're 20, 30 years old. When you're maintaining a house, you get older.
Sure.
Things happen. Life's changed.
You get to our age.
You have kids. I mean, heart attacks are real. Cancer is real. And you don't plan for those situations. Yeah. But the mortgage doesn't stop every month. It keeps coming. It's hard to get a deferment in those situations. It's possible, but it's a pain. And it's probably a pain at the worst time of your life is trying to go through those things. So an insurance policy is clutch in those situations, and being self-insured, self-mortgage is huge. It's a huge benefit, flexibility.
So for example, if you have a change in health, okay, a living benefits and insurance policy will pay you just in case your health changes, or obviously death. You actually have a case study about that. You have a client.
Yeah, we had a client we helped buy a house a year and a half ago or two. Lovely young couple. They had a couple kids. And the month after they pushed the home, the husband passed. And she called me in despair. I can't afford the mortgage on my own. I have to sell the house. We did add some sort of vehicle, private insurance to help cover the mortgage for 6 months or half of the mortgage for 6 months in case of bereavement, things of that nature, which was helpful. but she still ended up having to liquidate, fire sale the house because she couldn't afford it, number one, falling behind. So now you have this debt where she's facing possible foreclosure at a time in her life when she doesn't deal with that kind of stuff. Her husband just passed. So she ended up having to sell the property shorter than what she bought it for, and then pay the cost again of what that was, right? Had she been able to avoid that with these situations? More than likely, but we're not taught that.
Yep.
We're not educated in those regards.
100%. So if you have a house, you have mortgage, you have debt, you have things that you want to plan for, right? That's why you bought the house. That's why living benefits, not all life insurance is created equal. And when you try to bring this up to your insurance agent, they say, do I have living benefits? They say, oh yeah, you can access the money while you're alive. Usually that means terminal illness. That means you gotta be terminally ill. The doctor has to get, they give you in 12 months, you're going to pass away. Yeah. That's called terminal illness rider. It's not the same thing as critical illness rider. So two different terms. You have to make sure you ask very cleanly and clearly to your insurance agent. And I tell you this because we're gonna have our convention next week in Las Vegas. All the companies we do business with that have living benefits on their policies are there. And guess what? Hint, hint. Not all life insurance companies have living benefits on their policies. So that's why we're bringing them about convention, because we want our agents to know who they are. And because life happens. Things like this happen. You don't believe me? Go to GoFundMe?
Oh, yeah.
GoFundMe.com. See how many young, healthy people are there, and next thing you know, life change, health change, and now they're asking for money. A lot of that stuff can be resolved through getting the proper life insurance, and the insurance would be significantly cheaper than what you would pay GoFundMe and credit card fees.
100%. Now, the big thing here is some of these terms and options may seem a little unfamiliar to you. So don't be intimidated by the terms and options.
Yep.
At the bare minimum, every homeowner should have a term life policy to cover at least the mortgage balance and let's just say a year worth of expenses, if not more. I would say twice the mortgage value is probably smart to cover some salaries in that situation. So every time you buy a house or you have a home that you own, you should have a term life policy of 20-year term, typically, maybe longer if you can reinstate, to cover at least the mortgage balance. And term, not mortgage protection, not mortgage insurance, but term life insurance on yourself to cover liability in the case of someone does happen pass away during the process. Or in this case, we have the benefits riders, which are even more beneficial, but at least the term life to cover that.
Yeah, exactly. So it was a wrap up. You look, most loan officers or real estate agents, after closing, after getting the house, after going through the whole process of getting a mortgage, sadly would never see the client again for how many years?
I'm gonna say 7 to 10 years. We see in this business a mortgage being paid off on average every 7 to 10 years, which means maybe they're not paying it off, but they're refinancing it, or more than likely selling the home to buy another home, upsizing or just changing because of life. So 7 to 10 years. So as a loan officer and realtor, we're not very transactional. The repeat customer is tough to come across. It's a decade later that you get another client. So it's hard to keep hands and hold their hands for a decade, right? So marriage doesn't even last that long.
I mean, you've been to my house. Yeah. I live in a fairly decent neighborhood, right? Yeah. Probably one of the top neighborhoods in Frisco, 100%. Right? Yeah. You got professional athletes and C-suite executives that live in my neighborhood. I haven't seen my realtor for a couple of years now. And before that, then after closing, maybe for that Thanksgiving for the turkey, we got pies, giving pies. But after that, a couple years later, I still haven't seen her. Yeah. I can think of maybe 3 or 4 text messages, interactions, kind of keep things cordial. I saw your video, we have a common friend. But there was currently right now, there's no real reason for her unless we're ready to buy another home. So, but the thing is, a lot of loan officers too, I would say you're more of the studious between a loan officer and a realtor. Because because you get to see their financial picture.
Yeah, no doubt.
What are some areas of opportunities that a lot of loan officers you think miss just because you're addressing only the mortgage?
Yeah, number one is going to be insurance, number one. And then number 2 is financial planning, leveraging assets, protecting assets. I see a lot of self-employed consumers on LLCs, on Schedule Cs, not LLCs, sole proprietorships, not having the right coverage for their corporate structure. They're not having enough insurance to offset either of those. I've seen customers coming to me with entire corporations built off of sole proprietorship, and they will have 15 vehicles financed, 50 employees, and not have one shred of insurance.
And not even a protection of a corporation.
Nothing.
Sole proprietorship. Holy moly.
So, one employee gets hurt and your whole empire is crashed and burned, and so is your family. Yeah. So there's so many things that we're not taught, and this is key. Number one is just protecting yourself. Yeah. Number one is protect yourself. Number two is then grow, leverage, and grow.
So Keep the Keys book is coming out August 4th, next Monday. It's going to be available on Amazon. So my book is the bridge between the close, the bridge between the next refinance, the bridge between your next home or real estate investment. For loan officers out there, real estate professionals, tax professionals, this is allowing you to maintain that top of mind awareness through education and getting them ushered to the next financial position in life, because you help them in their best financial picture, right? People come to you, the best credit score, the best down payment of their entire life, right?
They've been building up to that.
They've been building up to that. But we all know, just like any credit score, like anything in life, like or any reputation, takes forever to build it up. Yeah. One bad decision when change in life happens to attack it.
It's a game of Jenga, right? You pull that one lever and the whole thing collapses.
Like Jenga.
Yeah, Jenga.
Yeah. So you want the Jenga aspect in your life. So get the book, Keep the Keys. So if you go to my website, keepthekeysbook.com, we have a free worksheet for you guys. It's called a clarity worksheet. It's called a score worksheet to figure out where areas you're exposed, areas that you're good to go in, or maybe the areas that you're at risk in. So go to my book website, keepthekeysbook.com. Even before the book's even out, I'm giving you some free tools and resources to keep you in their life, to keep you as a realtor, as a loan officer in your client's life, and for you as a homeowner to make sure that you're staying on top of it. Because there is obviously, for my real estate professional out there, there's more value in that relationship than just the transaction.
100%.
And relationships are everything, right, big dog? 100%. So we will be in Las Vegas next Monday for our annual convention, August 4th to the 7th. We got Ray Lewis coming out. We got Coach. I'm interviewing Coach K on stage. Right. Very interested in talking to Coach K. I'm doing the Keep the Keys presentation, another version of this, on stage in front of 10,000 people. But if you want a live book signing, I'll be there on Monday morning from 10 a.m. to 12:30 noon 30. Was it the right way? 12:30 p.m. to have a live book signing at our annual convention. And by the way, Eli, did you hear who's going to be performing for us?
I haven't heard yet.
Jabberwockies. Oh, Jabberwocky. We have a private show with the Jabberwocky, bro. I want to go backstage and do something funny with these dudes, man. But the original guys are Filipino, right?
Yeah.
Representing the Philippines, baby. That being said, if you found value in this video, make sure you follow Eloy Benavides here on Instagram at Ask Eloy B. Ask Eloy B. Make sure you follow him.
No doubt.
And by the way, Eloy, you were the reason I ran across you. Tell everybody your former presidential roles.
One of my roles was a nonprofit. We ran called the NAREP, National Association of Hispanic Risk Professionals here in Dallas. I was president of the chapter for a year, and our main focus is to help. Number one is help you create home ownership, but number two is help build generational wealth. And that's when your and my path crosses on those times. We had sponsored some different events, and we had a lot of fun with it. And we're helping the community, number one, become homeowners. Number two, get some wealth. And that's something that we aren't taught in certain segments of the population, and we're trying to pass that message along.
The most interesting thing is the founder of NAREP. He's Asian looking, but the brother speaks Spanish. What's his name again?
You're talking about Armando Tam. Yeah, the CEO. He is Nicaraguan and something else. So yeah, he's definitely Asian, but he is Latino as well. And he's a very interesting character. Yeah. He is very passionate about the missions we have.
Great organization, man.
100%. 100%. Yeah.
That being said, guys, if you found value, please put your biggest takeaway in the comment section below. If you want access to the tools, go to keepthekeysbook.com. If you want to talk to me directly, we have a link here called Connect to Me. I'll text you back, I'll video respond to you back, or we can set up a 15-minute strategy session on Connect. That being said, guys, from Dallas, Texas, from Plano, Frisco area, I'm your money smart guy on behalf of Eloy Benavides. And until we meet again, continue to live smart, continue to love smart, and be money smart today.